India has slipped to become the sixth largest economy of the world, whereas not a long time back it was the fourth largest economy of the world. Our country grows its economy at 6.5%, the fastest rate amongst the major economies on the planet, and its GDP has literally tripled in the last one decade. And its stock market is the fourth largest in the world. Its digital payment volume is the highest on earth ever, and yet the International Monetary Fund IMF quietly releases a report in April of 2026, and this country has just slipped from being the fourth largest economy in the world to the sixth largest economy. And this country is India.
Last year, India briefly became the world's fourth largest economy. This year, it's back to sixth. According to the IMF's latest World Economic Outlook, India's economy is now estimated at about $3.92 trillion for FY26. The UK is at $4 trillion, Japan at $4.44 trillion. That gap is enough to push India down 2 ranks. It may sound like a setback, but it isn't. At least not in the way you think. In rupee terms, IMF data shows that India's nominal GDP expanded by roughly 9%. So why the drop?
And no, this is not just an economic collapse overnight. What has happened is far more fascinating, far more technical, and far more revealing about how global economies they actually work. And today, we are going to break this down completely, honestly, and without any spin. Hello, my name is Preetpal Singh, and all of you are watching Perspective. Now let us first try to understand that how did India even get to the fourth largest economy in the world. Let's first establish what India has achieved before we explain what has changed. Since the year 2014, India was the world's 10th largest economy, with a GDP hovering around $2 trillion, nearly 7 decades after independence. And this is a remarkable feat and a huge feat for a country like India, which from the ruins of independence, it became the 10th largest economy in 7 decades. Now then something dramatic started to happen. A combination of economic liberalization, the GST rollout, and a digital payments revolution in the country, and sustained high growth rates, it powered India's ascent. By 2021, the economy crossed the $3 trillion. And just in the next 4 more years, India added another $1 trillion, overtaking Japan to become the fourth largest economy of the world, sitting behind only United States, China, and Germany. Now this was something which was extraordinary, and this wasn't just a feel-good milestone. India's nominal GDP tripled from 106.57 lakh crores in 2014-2015 to 331.03 lakh crores in 2024-2025. Also, real growth in India was real, the trajectory was real, and service exports, they more than doubled, growing from around $158 billion in 2013-14 to around $387 billion in 2024-2025. And not just this, cumulative FDI inflows in our country, they reached at around $1.05 trillion. So there was no illusion here. India was genuinely rising. But then came IMF's April 2026 World Economic Outlook rankings. And they look something like this. With respect to country's economic size, the largest economy in the world, that is the first one, is United States of America with $32.38 trillion. Second is China with $20.85 trillion. And at the third number, it's Germany with roughly around $5 trillion GDP. And at the fourth number, it is Japan with around $4.43 trillion GDP. And at the fifth number, it is United Kingdom with $4.26 trillion GDP. And the sixth number now is India at around $4.15 trillion GDP. Now, India has slipped to the sixth largest economy in the world according to the latest data released by IMF, with a GDP estimated at around $4.15 trillion, placing it slightly behind the United Kingdom, which is approximately at $4.26 trillion. Now let's break this entire reasoning down into 2 distinct but interconnected reasons. So the first reason is the statistical earthquake. Now this is the most important part of the story, mind you, and it's almost never explained properly, which is why please listen to this very, very carefully. On April 27, 2026, India's Ministry of Statistics and Program Implementation, in short we call it as MOSPI, released a new series of national accounts with a revised base year of 2022-2023, replacing the old one of 2011-2012 base year. That is, the last base year was in news for over a decade. And which is why this changing of the base year was quintessential, was required. But now answering the first question, what is this base year? And what is base year in GDP calculation? How is it relevant? So think of a base year as like this. When you measure how much an economy has actually grown, you need a reference point, right? A fixed year whose prices you used to compare against everything. And if your reference year is too old, the picture which you get becomes distorted. Like using a map from 2011 to navigate a city in 2026. India's old base year of 2011-2012 was deeply outdated. And it didn't account for the rise of the digital economy, it didn't account for GST network, it didn't account for the formalization of millions of businesses or post-pandemic structural changes as well, which is why the new base year was designed to be more accurate and to more accurately reflect the realities of the informal sector in an economy, which has undergone massive shifts following demonetization, implementation of GST, and the COVID-19 pandemic. Now, all of this might be sounding like an improvement to you, right? And it is definitely an improvement, but here's where the paradox hits very, very hard. While the percentage of real growth increased, real GDP growth from financial year 2025-2026 was revised upwards to 7.6%, the absolute size of the nominal economy of our country, it contracted by approximately 3.3%. In plain English and simple English, India is growing faster than what we thought, but the starting size of the economy was smaller than what we thought. The financial year 2025-2026, the nominal GDP dropped from an estimated 357 lakh crores under the old series to 345 lakh crores under the new series. It actually erased roughly around 12 lakh crores from the national books overnight. And this is something which you need to understand. And that's approximately around $140 billion wiped out not by recession, not by unemployment, or not by any real economic event, but just through statistical recalibration. Now, official data, they show downward revision of between 2.8% to 3.8% across recent years, which has also fed into the lower IMF projections. And which is why that is the first most prominent reason you see Indian economy becoming the sixth largest economy. Now, was this revision legitimate? Of course, yes. And most economists, they would agree that the new methodology is more accurate. The new series introduces double deflation in manufacturing, which is a better method that separately tracks input and output prices and reflects the post-GST, UPI-driven digital economy more faithfully. Which is why the revision was actually accurate. It was good. But here's the uncomfortable part. In the late 2025, the IMF had assigned India a C rating on its national accounts, explicitly citing concerns over the outdated base year data, which is why we had to upgrade it. And this external downgrade, it threatened India's global statistical credibility overall. And financial researchers indicated this institutional pressure, it forced the government to expedite the new series. And which is why in 2026, we saw the coming up of the newer series. So this revision was both necessary and overdue as well. But the timing of this impact on the rankings was brutal. And which is why India became the sixth largest economy in the world. One reason is a statistical nightmare, statistical recalibration. So one was the reason for statistics. But there's a second reason as well, which many people and many news channels or many analysts won't talk about. And that is the rupee problem. Now here's something most people completely miss in this conversation. GDP rankings are calculated in US dollars, not rupees, not PPP adjusted baskets. Raw, nominal, dollar-denominated GDP. This means that if rupee weakens against the dollar, even if your domestic economy is growing, your ranking in dollar terms, it's falling. The rupee has remained under strain and high oil prices, and also the geopolitical tension in the West Asia and foreign capital outflows trading in 94 to 95 rupees per dollar range. It is actually bad for our economy. And in multiple terms, multiple areas, it is bad for the economy. And one way it is bad for the economy is with respect to Indian economy becoming the sixth largest. Now, first of all, compare this to the British pound, which has remained relatively stable. So even though India's economy in rupee terms kept expanding, when you converted that to dollars, the number actually shrank. And the UK's number converted from pounds held steady or even grew in dollar terms. So India's GDP is estimated at around $3.92 trillion in 2025 and $4.15 trillion in 2026, while the UK's GDP is expected to be $4 trillion in 2025 and $4.26 trillion in 2026. So the margin is not enormous, but it is enough to push India into sixth place for both the years, which is why we very carefully see that the first reason was statistical nightmare, statistical recalibration, but the second reason, major reason, was the rupee getting weakened against the dollar. And this isn't the first time currency movements have decided India's ranking. See, if you see historically, India's global ranking have been sensitive to exchange rate fluctuations a lot. And not just this, India's ranking have been sensitive to oil prices as well. And they have been sensitive to global economic conditions also. And similar shifts have occurred in the past due to currency movements rather than the actual economic slowdown. So what we very clearly understand is that India's GDP has not gone down, or it is not that India suddenly have started decreasing its GDP or suddenly have started growing at a lesser rate, but it is due to these reasons India has become the sixth largest economy. See, the irony in this is almost poetic. India has previously been celebrated for overtaking the UK in GDP rankings, a moment treated as a symbolic milestone of India's economic progress. That the UK has now reclaimed its spots, even temporarily, it carries obvious political and psychological weight on India, which is why these rankings needs to be studied carefully. See, India is growing 8 times faster than the United Kingdom. A real GDP growth rate of 6.5% versus UK's 0.8%, and yet the UK ranks above India in dollar terms. This is the brutal reality of how nominal GDP rankings actually work. So which is why I hope both these reasons that are very, very clear and you are now able to distinguish that was Indian economy not performing well, or was there other reasons which led to the downfall of Indian economy. See, both of these problems, the outdated base year and the measurement challenge, point to one deep structural issue that India hasn't fully resolved, and now we will be talking about that. And that is actually measuring the informal economy accurately. See, informal economy in India is a very big problem. It's actually a nightmare. Nearly 90%, I'm using this data, 90% of India's workforce, it remains in informal sector, limiting productivity, income security, and critically for statisticians, accurate measurement. Which is why informal sector dominance in Indian economy has actually taken Indian economy back. When you can't measure an economy really well, your GDP numbers are always going to be unstable. They'll always be revised and they'll fluctuate with the methodology changes, and they'll create exactly the kind of headline we are seeing right now. See, a paper published by researchers Anand, Feldman and Subramaniam through the Peterson Institute of International Economics in March 2026, it argued that India's GDP has been overstated by over 1/5 and consumption by nearly 1/3, triggering one of the sharpest official rebukes in a recent economic history. And this doesn't go really well for a country like India. See, the government pushes back hard on this, but the very fact that this debate exists tells you something. India's economic measurement infrastructure is a work in progress. We all are aware of it. And until it's fully resolved, ranking volatility will remain a feature and not a bug. So the actual question we should be asking ourselves is that where do we actually stand? See, let's be very honest about what this ranking drop does and what it does not mean. See, it does not mean Indian economy is contracting. The IMF projected India's real GDP growth at 6.5% for 2026, the highest among all major economies, significantly outpacing US, China and Germany. So which means Indian economy is not in a bad state. It does not mean India is becoming poorer. Incomes are rising in our country, infrastructure is expanding, digital adoption is accelerating. But then the question is, what does it mean? See, what it does mean is that nominal GDP rankings are a flawed metric. They reward countries with stable, strong currencies and punish countries whose currencies depreciate against the dollar, regardless of the underlying growth. And by purchasing power parity, PPP, which adjusts for what money can actually buy in each of the countries, India is already the third largest economy in the world, behind only US and China. So with respect to PPP, India is already the third largest economy. And on the forward trajectory, IMF projections indicate India could regain the fourth position by 2027 as its GDP rises to $4.58 trillion and surpasses Japan by 2028. India's GDP is projected to reach at around $6.17 trillion by the year 2030. And beyond 2030, if India and US maintain their forecasted growth rates of 6.5% and 2.1% respectively, India may surpass the US economy in PPP terms by 2038. And this is not normal. This is extraordinary for a country like India, which has seen extreme poverty for many, many decades. See, here's the question that matters more than any GDP ranking. Is India's growth reaching its people or not? That is a question which we must ask. With a population of roughly around 1.4 billion, India's GDP per capita stood at around $2,600 to $2,700 in 2024, placing it around 122nd globally. By comparison, Japan's per capita income is more than $30,000. Germany's per capita income is more than $56,000. US per capita income is more than $80,000. So the question is not that the GDP is high or low. The actual question is about the living standard of the public. See, the ranking on the chart changes nothing for the hundreds of millions of Indians who are still waiting for economic growth to translate into real income gains and to translate into stable employment and social mobility. See, India is genuinely an economic powerhouse in the making, but the ranking measured in dollar terms, subject to currency swings, base year revisions, and statistical methodology, will always be volatile. See, the real story isn't that India has slipped from 4th to 6th position. The real story is that a country growing this fast with this much demographic potential is still spending its political capital celebrating ranking changes instead of asking the harder question, that is, how do we make sure that the next $1 trillion of growth is felt by the bottom half of the population? That's the question that will determine whether India's economic story is merely impressive or actually historic. If the benefits of the fruits of the growth, it reaches the bottom half of our population, then we will be able to say that Indian economic story is a success. I hope you gained a new perspective from this session. Do let me know what are your views regarding it in the comment section. All the very best. Have a beautiful day. Thank you.